Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Outline of the presentation, how in essence we're going to achieve these objectives. Going to go over the options basics and the background of the Greeks very, very briefly. Just talk about those in the sense that we're talking about volatility. What does volatility mean? How is it priced in an option? What are some of the different models out there that people can use when it comes to that? Going to talk about the realized volatility and the implied vols of 6 currency pairs, which the ICE FX options allow you a chance to effectuate some exposure on or take on some exposure. Going to go over some common strategies in the declining volatility environment, and I've kept these strategies pretty low risk. Most of them actually entail just neutralizing your Greeks as opposed to actively attacking them. And I'll touch on more when I say neutralize the Greeks what I mean. And then lastly, of course, the presentation going to spend a lot of time over the real-time market application and at least how I'm looking to position myself in the coming days and weeks. All right, a background of options, just again very briefly here. When I talk about a call, I'm talking about the right but not the obligation to buy a given vehicle at a specified price by a specified date and time. The put obviously entails the inverse of that, talking about the right but not the obligation to sell a product at a specified price by a specified time. Again, gives you the right but not the obligation, so you're not on the hook in essence if you want to abandon the position or not exercise. That is the insurance price. When I say the strike price, I mean that's the price that option would be exercised at. For calls, the lower the strike price, the more valuable the option is for obvious reasons. Obviously, the higher the price is on calls, the higher the strike price, the less expensive the option will be. Opposite, the inverse of that for puts, the higher the put price, the more expensive the put will be. The lower the put price, the less expensive that put price will be. Implied volatility, which is very much the basis, and there are many quant funds out there and traders out there that make a living just on predicting volatility. And I mentioned earlier that rising volatility has been associated more with maybe a risk-averse theme, and whereas falling volatility is more associated with a risk appetite theme. And this isn't always the case. As we look over historical charts, we can see volatility meander in the low teens, and in the case of the VIX, which is probably the most widely followed volatility gauge in the world in terms of what's happening with S&P 500, S&P 100, or OEX options. You get a sense of just how volatility has come and gone. You look at the spikes of 98, 2000, the very low, really tranquil environment that we operated in up in 2005, 6, and 7, where we saw the VIX just kind of hang out in the low teens, and then obviously once again with the records, with the VIX hitting north of 80 last year, and just what that meant in terms of realized volatility is I'll show you some of these upcoming prices. So I've gone over some of the verbiage in terms of the actual nomenclature behind an option, but what really comprises those values. So really focus on 4 things here: the delta, the gamma, the theta, and the vega. And I've talked about the delta, gamma, and theta in the past. We've mentioned gamma trading and delta hedging and whatnot. That's not so much the thrust of today's dialogue or topic, but what we will focus on is the vega, and that's the volatility component of that option and how exactly it affects that option based on a rise or fall in implied volatility going forward. Have those. All right, so when we talk about implied volatility, and implied volatility is very simply stated, and it's a big difference from realized volatility, but implied vol is the perception of the future standard deviation of that underlying market. Okay, so if there's a perception that that there's going to be a lot of range, or there's a lot of risk, or potentially a lot of risk associated with that market, you're more likely going to see a higher volatility or a higher premium paid for those underlying at-the-money calls or puts. Conversely, if the perception is that there's much less risk about the market going forward, you'll see low premium paid. I say it's akin or analogous to if you're an insurance company, you have a 16-year-old with a DUI, what the chances are of him going out and doing something ill-advised again is probably greater than a 35-year-old mother of 3 who drives a minivan. And so that perception of that implied volatility encompasses and embodies a number of factors there. For my software analytics, I have a Japanese yen component right here where to give a perception of what this I get to get this mouse cursor here on this. I didn't want to do that. Give me one. second, guys. Going to get a cursor so I can show my arrow. Can you guys see my mouse move around here?
I don't think so, John.
Okay.
You can click on that arrow and then sort of just, you see that arrow at the top?
Okay, there you go. I got it. I apologize. All right. So when I talk about performing an analysis on let's say the Japanese yen, okay, the software I have, I'm using another exchange just to get a sense of what one would mean. So right now the yen is trading what it was when I recorded this at 108.38. Okay, so what would happen with volatility at 16.30 on the at-the-money calls? All right, if volatility fell by 1%, what would that mean in real value based on this black model of pricing options in terms of a decline? And what that at 183 pips, all right, a fall by 1%, okay, would mean about an 11.7 pip decline in the value of the option. With everything else being equal, is that being the case? Conversely, on the it was not conversely. It's very much same with at-the-money puts. The same dynamic would happen as well. So, if let's say you were short a straddle in this spot and volatility fell by 1%, you'd pick up about 23 ticks of value based on that move. So that's in essence, we talk about a vega. I mean, like what happens based on a 1% change in implied volatility of that option? If it goes up by 1%, you would see, ideally the same, theoretically the same rise. If it falls by 1%, with everything else being equal, with all the other Greeks being traded in a vacuum, you'd see a fall by 1%. So with that being stated, we'll move on to the next one here. So that again, we're just showing a call position there with the, happen to be long 1 yen with that call. If I'm long this call, albeit this is my ultimate risk in the trade, $2,200 roughly in there, but just seeing where even a 1% fall from this red line right here, which is where it's at right now, if we lost 1%, that's how the current P&L would be affected as a result of that. So you'd be down about $190. So you take about a 10% whack in your at-the-money call if volatility fell off by 1% there. And something that we want to talk in the context of, again, the class's title is, trading FX option strategies for a declining volatility environment. And so one of my favorite currency crosses that I like to follow is the Aussie dollar. I mean, you talk about a cross that embodies, more than just risk-averse risk appetite, but carries with it a very heavy commodity dynamic. It's a currency that you can follow in terms of, we're going to see it get going here in another 3 hours or so, to 2.5 hours when that side of the world wakes up and really gets going with their equity markets and just what kind of follow-through we have. I suspect, just based on what we're seeing from the Intel news and what the S&P is doing, now S&P just printed 912.5, that we're probably going to see a bit of a boost here in that Aussie USD. Upon the open, we'll probably see a bounce in the Nikkei, and we'll see the yen come under some pressure. Just kind of if we get the good news off of that announcement, I suspect that move will probably carry over into Europe, and sometime tomorrow morning they'll probably come in and probably sell it early on and fill that gap, and we'll come back down to the S&P again. Currencies will pull back a little bit, and then kind of where we go from there is where you make your money as a trader. But that's just talking off the top of my head what I'm seeing.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.